Welcome back to Market on Close. I'm Renita Young in for Oliver Rennick, and we have about 10 minutes left in the trading day before the close happens. But right now we want to talk with our panel, and for that we'll bring in Kathy Jones, Chief Fixed Income Strategist at Charles Schwab, and then Michelle Gibely, Director of International Research at Charles Schwab. Ladies, thank you for joining us. Kathy, let's start with you first. Did anything stand out to you in the fixed income space today as we look ahead to CPI tomorrow?
No, it was a pretty quiet day today. I think everyone's kind of waiting for those numbers to come out. There's a lot of expectation that we'll get a good number in terms of a low print, both overall and on the core numbers. I think official consensus is 0.3% for each month to month. That would represent a pretty good decline year over year. But there are some people looking for even better numbers, 0.2, even 0.1. So everybody's kind of on hold because this is a big input for the Fed.
Kathy, you say we've got good news and bad news that might come tomorrow. So explain what you mean by that.
Well, the good news is inflation should be down pretty substantially year over year. The bad news is it's probably not going to change what the Fed decides to do at the July 25-26 meeting. So it looks like getting a rate hike there is a foregone conclusion, and this number, maybe changes the future direction, but not next week, not this month's meeting.
Michelle, are you expecting anything specific from the inflation data tomorrow, maybe versus the other international inflation data figures that you've seen coming out recently?
Well, I would say that globally, inflation looks like it's peaked on a headline level, but core inflation is still pretty high. We had some strong job and wage growth numbers internationally. Today in the UK, we had wages growing 7.7% year over year on a nominal rate for the private sector. And then on Friday, we got a report from Japan, 2.5%. And higher wages can reinforce the inflation dynamics because wages are an input to the price of most goods and services. Bank of Japan doesn't meet for a couple more weeks, but expectations there are increasing that they could move away from their dovish policy stance. Tomorrow we get the Bank of Canada. Their jobs report on Friday showed 3 times as many jobs as expected were created, and so there's a potential for a rate hike there.
It's a really different situation with each of these. China's inflation remains almost non-existent. How is that possible right now? Is it because of the slower comeback from COVID, or what are you thinking?
Yeah, definitely the slow economic growth is not helping in terms of China's economy or their inflation. It came in at 0.0% overnight in China. Rate cuts there are possible. They've done some rate cuts, but it may not really help what ails its economy. Rate cuts, it's likely to worsen a weak yuan, which is good for export competitiveness, but it can dissuade capital inflows, which could be a negative. What they really need is something to boost sentiment and animal spirits. They're starting to increase the number of stimulus actions, in particular for the property market. But so far, the measures are focused on the supply side of the property market, so help for the developers to finish already started construction. But they've yet to provide any support on the demand side to boost property sales. But those could be forthcoming in, coming days and weeks.
All right. Kathy, I want to ask you about a good report tomorrow. If it comes in better than expected for CPI, would the Fed reconsider a rate hike at the end of the month? What do you think?
It seems doubtful. I think the Fed's been pretty clear that it's communicating it wants to see a series of good inflation readings before considering any change in policy. And, the CPI is important, certainly, but there's a lot of other factors that they're watching. They really focus a lot on the core PCE reading, the deflated for personal consumption expenditures. So they'll want to see that number. They'll want to see some more labor market data. The Fed is very much focused on the idea that the labor market needs to cool off some more. So I think before they alter the signals that they've already sent, they'll need to see some more readings. That being said, one of the interesting things about this meeting may be that there's a dissenting vote or two. We're starting to hear a little bit of difference between various Fed governors as to what their expectations are for the economy, inflation, and policy.
That is interesting to note. I'll be watching for that. Kathy, quick follow-up for you about the areas of fixed income. Which areas do you think investors should be watching right now, should be focused on more so?
We still like the idea of extending duration, adding a little bit in intermediate and longer term bonds. Excuse me, because we do anticipate that inflation will come down and those yields will fall. And then we want to stay up in credit quality and investment grade corporate bonds, investment grade municipal bonds, treasuries, other government backed securities. We want to be more careful about the lower credit quality bonds because there's a risk of, over tightening in a credit crunch.
Michelle, last question here for you. Which parts of the globe pop up on your radar as the best ones to watch as we head into the next half of the year?
Watching our Japanese stocks and Indian stocks. In Japan, they look very inexpensive on a price to book ratio. Over half the stocks on the Tokyo Stock Exchange are below 1, and that's relative to 2.8 for the world ex-Japan. And there's some changes there to basically boost stock buybacks. In India, they're gaining a lot of traction as more people enter the middle class, and the government is making changes to increase its attractiveness as a manufacturing base. It's trading at a high valuation multiple, though, higher than average. So you might want to wait a little bit to see if you can get a pullback there.
All right, Michelle Gibely, Kathy Jones of Charles Schwab, thank you for joining us.